There exists a vast deception at the heart of the global silver market. Not a conspiracy in the traditional sense, but a structural illusion that has been accepted as reality for so long that most participants no longer question it. The price of silver is not determined by silver, it's determined by promises of silver. Contracts, derivatives, unallocated accounts, exchange-traded funds, paper instruments that claim to represent physical metal. But the relationship between these paper claims and actual silver has become so distorted that the system now functions on belief alone, and belief, once shattered, cannot be restored with more paper. Consider how silver is actually priced in global markets. When an investor checks the silver price, they're not seeing the value of physical metal changing hands. They're seeing the clearing price of futures contracts traded on exchanges, contracts that represent promises to deliver silver at a future date. But here's the critical detail most observers miss. The overwhelming majority of these contracts never result in physical delivery. They're settled in cash, rolled forward into new contracts, or closed out before delivery becomes necessary. This creates a peculiar dynamic. The price discovery mechanism for a physical commodity occurs in a market where the commodity itself rarely appears. It's as if the price of houses were determined entirely by people trading options on hypothetical houses, with actual houses almost never changing hands. For years, this system functioned without obvious stress. Participants accepted that paper silver and physical silver were functionally equivalent, that a promise of delivery was as good as possession, that leverage and derivatives could adequately represent underlying value. But every leverage-based system contains a fundamental vulnerability. It works perfectly until the moment participants demand settlement, and rising prices are precisely what triggers that demand. The paper-silver market has expanded far beyond any reasonable relationship to physical supply. Each ounce of actual silver sitting in approved vaults has been promised, leased, hypothecated, and rehypothecated multiple times. One physical ounce backs dozens, sometimes hundreds, of paper claims. During normal market conditions, this leverage suppresses volatility, it creates liquidity, it allows large positions to be established without moving prices dramatically. But it also creates catastrophic fragility. When stress enters the system, leverage stops being an advantage. It becomes an accelerant. As silver prices climb toward and beyond all-time highs, a dangerous question begins spreading through the market. Can I actually get the metal, not next month, not under favorable market conditions, but right now, immediately, with certainty? This question seems simple, but it exposes the entire architecture of the paper market. Large institutional investors, sovereign wealth funds, industrial users, pension managers, they don't want exposure to silver price movements alone. They want assurance of delivery. They want to know that when they purchase silver, they're acquiring an asset, not just a bet on price direction. And this is where the cracks begin appearing. Exchanges allow cash settlement as an alternative to physical delivery. ETFs permit redemption only under specific conditions that favor the fund structure. Unallocated accounts promise silver without identifying where that silver is stored, or whether it exists in allocated form at all. Bank metal accounts offer price exposure without guaranteeing access to specific bars. These mechanisms were designed to create flexibility, to prevent delivery squeezes, to maintain orderly markets. But they function only when participants don't simultaneously demand physical settlement. History reveals what happens when confidence shifts. When enough market participants decide they want metal, not contracts, possession, not promises, certainty, not counterparty exposure, the system faces a problem that cannot be solved quietly. Either physical metal must be sourced at whatever price necessary, or contracts must be settled in cash, effectively admitting the paper market has decoupled from physical reality. Both outcomes are destabilizing. One drives prices violently higher as available metal becomes scarce. The other exposes the fractional nature of the entire pricing mechanism. Neither restores confidence, neither creates stability. What makes silver uniquely vulnerable to this dynamic is its market size. Unlike gold, which has a deep and liquid physical market, silver is comparatively tiny. The entire annual global silver production is worth less than a single day's trading volume in major equity markets. It doesn't require trillions of dollars to stress the silver system. It requires a shift in behavior,